Inheritance tax. What is it and what can you do about it? Are you worried about inheritance tax? Are you dealing with an elderly relative, or are you looking at your own situation? Inheritance tax is one of the most divisive yet misunderstood taxes in the UK today. Continue watching here and I will explain what you need to know and what you can do about it. Hi, I'm Adam Walkham, a financial planner, entrepreneur and author of Plan for Happy. I've built a very successful financial planning business helping my clients take the worry out of achieving a successful retirement. And now I want to help you do the same. Inheritance tax. There are not many other two-word phrases in the UK tax system that create as many discussions, but also misunderstanding. To work out what your own situation is in regards to inheritance tax, more importantly, what you can do about it, let's first go through the rules. To recap, on death, the value of your assets are totaled up as part of your estate. The first £325,000 of this is known as your nil rate band, and this attracts no inheritance tax. Any balance of the estate that is worth more than £325,000 can be subject to 40% taxation. This tax will then be paid by the estate before any payout to beneficiaries, and then what is left is paid out to those beneficiaries afterwards. So that's the simple version. However, there are a couple of important caveats that you need to know about. The first, if you die and pass everything to your spouse who is still living, then there is no inheritance tax on that, and all of your nil rate band of the £325,000 also gets passed over to your spouse. So as a couple together, you get £650,000 nil rate band. Number two, there is also something called the Residence Nil Rate Band, which was introduced by the Cameron government back in 2015. This is where if you either own or have recently owned a property and the total value of your estate is less than £2 million, then you potentially can receive another £175,000 per person added to your nil rate band. So together, the £650,000 nil rate band of a couple can move up to £1 million. Let's have an example to work through this. Mr. and Mrs. Smith have a house worth £1 million and some savings worth £500,000. So the total estate is £1.5 million. Mr. Smith dies. He leaves everything to Mrs. Smith, so there was no inheritance tax to pay on his death. When Mrs. Smith dies, and we're working on the assumption here that the assets are still worth the same, £1.5 million, then her estate uses the first £325,000 of her nil rate band plus Mr. Smith's nil rate band of £325,000 plus the residence nil rate band of £175,000 each. This brings the total nil rate band for Mrs. Smith up to £1 million. This means her estate will be charged 40% tax on the £500,000 above the £1 million, which is equivalent to £200,000 in tax, leaving £1.3 million to be distributed to the beneficiaries. Does that make sense? Now, if the house was worth £2 million and not £1 million, and they still had £500,000 in savings, then they wouldn't get the residence nil rate band and would only have a nil rate band of £650,000. That's because the residence nil rate band is only applicable to estates under £2 million. In this case, £2.5 million total estate minus £650,000 of nil rate band is equal to £1.85 million. Multiply that by 40% and you get £740,000 in tax to pay and £1.76 million released to the beneficiaries. Through that example, you can see the impact of the removal of the residence nil rate band has to the overall tax situation. So that was an example. Now let's think about what assets count for inheritance tax. So your house and other investment properties, they definitely count. Savings in investments and cash, definitely count. Art, wine, classic cars, crypto, all count. Now, other income, like guaranteed pensions or state pensions, do not count. They die with the person who's dying. Other pensions, such as workplace pensions or defined contribution pensions, they normally don't count either. Investments in private trading businesses. As long as these have been held for 2 years, they don't count either. So please remember these last two examples as they're important for planning purposes, and I'm going to come back to those. So we've now understood inheritance tax a bit more, but most importantly now, what can we do about it? Let's start with most people's biggest asset, their house. And the simple answer is, unfortunately, in terms of planning for inheritance tax around your main residence property, you can't do much. Many people ask about putting a house in trust or passing it to their children, but this has problems if the person who originally owns the property is going to remain living in it. If there is a gift from the owner, yet they continue to live in it, this is called a gift with reservation and will still be counted as part of their estate. The only real way around this is if the original owner gifts the property and then pays a market level of rent to the new owners. Now this sounds good in theory, but is very rarely feasible. The good news, if there is some, on the house, is that from our experience, it actually becomes less of a problem as people age. The typical scenario we see, which is albeit rather blunt, is when the first of the couple dies, normally the surviving spouse ends up moving out of the family home and into a care home. At this point, the house is normally sold with some, or in some cases all, of the funds from the house used to cover the care home fees from the surviving spouse. It's not the most pleasant journey, yes, but unfortunately it is actually the most common. And from an inheritance tax perspective, this actually creates opportunities because the cash that is created by the sale of the home is a lot easier to deal with than a single house. Let me explain. Cash can easily be passed down generations, with the gift just being treated by the 7-year rule. Most people know this, and it's that after any gift to a beneficiary, after 7 years, that gift is completely out of the estate. Even better, after only 3 years, if there is a death, the full gift isn't counted, as there is some tapering. So gifting cash is an easy, straightforward option. The only problem is that once the money has been gifted, remember, it's gone. It's the receiver's money and they can do with it what they like. But some people may not want to gift their money straight away. Maybe they have young children or don't want their money being used whilst they're alive. In this case, a trust may be useful. I'm not going to get too technical on trusts because they can be very technical as there are many types. But the simple version is that once the money is gifted into a trust, again, remember that word gift, so the 7-year rule applies, then the trust owns it, and any growth in those funds as they get invested, which they should be, is outside of the estate, and the growth is owned by the trust. The trust itself has elected trustees who decide how the money is invested and when the funds are distributed to the beneficiaries. As I said, they can be quite technical, but are useful sometimes. The main problem with trusts is that if you put more than $325,000 into a trust, which is your nil rate band, you will immediately pay a 20% tax charge on any balance above this £325,000 level. This makes putting larger sums into trust much less attractive. On the pro side, they do allow you to retain more control of the money whilst you're still alive. So, what else can you do beside trusts? One of my favourite options is using something called business property relief, or BPR for short. BPR is the rule that if you die and have held investments in a private company or an AIM-listed company for more than 2 years, then this investment is exempt from inheritance tax. This is important because remember, the funds are not out of your estate. You haven't given them away. They're your funds and the investment is in your name and you retain full control. But if you've held them for longer than 2 years, they are exempt from inheritance tax. The original reason this rule was designed was to not destroy family businesses when they pass down a generation. However, this has been extended to allow investment into smaller British companies, either private or listed on AIM, with the tax incentive of the exemption from inheritance tax. Some people use portfolios of AIM stocks for this, which are okay, but tend to be very volatile. There are other investment options which uses a private company that owns asset-backed loans. These investments tend to be quite stable, but are also a little costly. But remember, the downside for this inheritance tax exemption is 40%, because that's the tax you would have to pay anyway. So as long as the performance of these portfolios are better than minus 40%, you're potentially going to be up overall. Okay, so that's another option. Other options I'm thinking about. Remember I mentioned that defined contribution pensions were not counted as part of the estate. This is important. A, this is the rules as they are today, and the Labor government have indicated they may be changing these rules. B, with an elderly person, there is not much you can do around their pension, with the exception of encouraging them to spend the funds that will count as part of their estate, savings, investments, before spending their pension fund. But pensions are much more useful for the younger person because they are really tax efficient in building them up, especially now that lifetime allowance has been removed. And you can make more of an active decision not to spend them if you have other savings and investments. For example, some people decide they want to downsize their house as a retirement plan once their children have left home. This often releases a good chunk of tax-free equity, as it's the main residence, that they use to live off in their retirement. Back to pensions. Yes, they are not counted as part of the estate for inheritance tax, but they still are potentially taxable for the receiver when they end up drawing the funds out. Other options to think about? Life insurance is potentially an option. Some people look at taking whole of life cover, which is paid out on death, with the amount covered being aimed to cover any inheritance tax liability. The problem with this is because there will be a guaranteed payout at the end, the premium payments can get very, very expensive. Insurance companies are not charities, and if they know there is going to be a payout, they will make sure they get the bulk of the payment in premiums beforehand. Also, a will can be very useful when it comes to inheritance tax planning. Having a will puts the firm plans in place on how you want your estate handled on your death. Going through this process is very good because A, it gets you thinking about what you want for your estate, and B, the solicitor can potentially suggest options for you to consider that you may not have thought of yourself. And finally, do you want to know the best way to reduce your inheritance tax that's absolutely foolproof? Spend the money. Nobody wants to be the richest man in the graveyard, so planning a full life of experiences and creating memories is one of the greatest ways to reduce the value of your estate. This way, you get to share the value of your assets with your chosen loved ones whilst you're still around. It's called giving with a warm hand rather than a cold one. A much more fulfilling experience for everyone. So that's it. I hope you found that helpful. Let me know what you think in the comments section below, and if you've got any questions, I'll see if I can help. See you next time.